JPMorgan created a possible replacement for two of their most popular income funds, JEPI and JEPQ. It's the same management team, but these two new funds, ROCY and ROCQ, are built differently in ways that can make a big difference to your income portfolio. So let's talk about it. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. I first want to mention there's a few problems with JEPI and JEPQ that have bothered investors. JEPI and JEPQ are two of some of the most popular income ETFs on the market for a reason. They give you exposure to indexes with a solid history, and they provide monthly income for a reasonable cost. But this doesn't mean that they don't come with flaws. And there's three pain points that stand out the most. First is the option strategy of JEPI and JEPQ. They both don't actually sell call options directly, and instead they generate income through ELNs or equity-linked notes. And ELNs can be complicated, and there isn't any transparency on how the ELNs that they use operate. And by that, I'm talking about the details of their options, which these days there's ETFs that have more dynamic strategies that you can also monitor their trades. Second is going to be the taxes because those ELNs. The ELNs let the fund distribute option premiums to investors as dividends, and that income from selling the ELNs are taxed as ordinary income. And now that we have options for more tax-advantaged income funds, it makes JEPI and JEPQ less attractive. Third is going to be that the income and total returns aren't that great. With more income ETFs on the market that use more dynamic option strategies, these funds now sit in a weird place. We have ETFs with more consistent income that have higher yields, or others with similar yields and more appreciation potential. And this gap can make a huge difference over time. And I figured JPMorgan caught on to this, and their answer was ROCY and ROCQ. Let's talk about what's actually inside these two funds. First, let's start with ROCY, the JPMorgan Equity Premium Yield ETF. The goal of this fund is to generate income with the potential for some capital appreciation. The income is generated from a mix of selling call option spreads and investing in US large cap stocks, so it can provide monthly income from the option premiums and stock dividends. This call spread strategy involves selling out-of-the-money call options while also buying long out-of-the-money call options to collect a net credit. And it has the potential for some upside appreciation when the market rises above the strike price of the purchase call. Also, ROCY is actively managed, and the managers are aiming for lower volatility than the broad US large cap market. And even though the fund is closely based on the S&P 500, it doesn't hold all the same names or have the same weights. For the portfolio, ROCY currently has 112 holdings, with top holdings in companies like Nvidia, Apple, Google, Microsoft, Micron, Wells Fargo, and more, while its sector exposure leans mostly in technology, then financials, communication, and consumer discretionary. And while there are some similarities with the S&P 500, you can see the differences in the top holdings with Micron, Wells Fargo, and Seagate there. And while it shares many of the same stocks in the S&P 500, they actually only have about 56% overlap by weight. So the managers are definitely adjusting how much to own of what. And compare that to JEPI, where none of the stocks are even over 2%, highlighting its more defensive approach compared to ROCY with more weight in growth and tech names. Next, we have ROCQ, the JPMorgan Nasdaq Equity Premium Yield ETF. This fund has the same objective and strategy that I talked about with ROCY, but one difference is in the stocks that it chooses. ROCQ invests in Nasdaq-listed stocks, which means you're going to have a portfolio that leans much more into technology. For ROCQ's portfolio, this fund has 97 holdings in total, and the top holdings include Nvidia, Apple, Google, AMD, Walmart, Intel, and more. The top holdings are pretty similar to the Nasdaq 100 with slightly different weights, like Lam Research, Walmart, and Intel making it into the top 10. For the sector exposure, technology makes up more than half, then communication and consumer discretionary. Keep in mind, ROCQ is not only limited to the Nasdaq 100, it can go further into the Nasdaq universe. And a smaller percentage of the fund is in non-Nasdaq companies like Johnson & Johnson, Exxon, MasterCard, and more. So ROCQ spreads out more than you'd expect, even though the heaviest holdings look familiar. Now let's get into the fees and the big difference with taxes when it comes to these funds. Most of the income that ROCY and ROCQ provides is classified as ROC, or return of capital, and not ordinary income. This return of capital income reduces your cost basis, and it allows your taxes to be deferred until you sell your shares or your cost basis becomes zero. JPMorgan issues a 19A notice every month when distributions are paid out. For example, here's the most recent 19A for June, and it includes both ROCY and ROCQ. And 93.5% of ROCY's payout is return of capital, while ROCQ's was 99%, which you can see in the second column. And it's important to keep in mind that these are just estimates and not final classifications, since they won't be confirmed until the end of the year when the 1099 DIV is issued. So it could look different in the end. Now, this is a pretty big difference compared to JEPI and JEPQ. Since the older funds use ELNs to generate income, those distributions are going to be taxed as ordinary income, and that will be at your federal income tax rate. So for all the payouts that you receive during the year, you will unfortunately have to pay taxes on them. Now for the fees, you'd think that these newer funds would be expensive, but ROCY and ROCQ have an expense ratio of 0.35%, costing $35 for every $10,000 invested. So you're getting a newer strategy from JPMorgan without having to pay anything extra for them. Now for the best part, let's dive into the money, which is the dividend income and performance. ROCY and ROCQ are both still very new since they were created in March 2026. So the history here is going to be very short. Kicking it off with the dividend history, we only have 2 months of payments so far. ROCY paid about 55 cents a share in May, while ROCQ paid about 67 cents a share. And for June, ROCY was 33 cents and ROCQ was 50 cents. This makes the forward dividend yield about 7.3% for ROCY and 10.5% for ROCQ. And keep in mind that drop in income is because that first May payment was for an extended time period of about 1.5 months from its inception in March. So June would be the first regular monthly payout. And when you compare these new ETFs to JEPI and JEPQ, they aren't exactly destroying them when it comes to the yields. JEPI currently has a dividend yield of 8.19%, while JEPQ has a dividend yield of 10.14%. So they're not too far off from each other, with ROCQ being a little bit ahead and ROCY being a little bit behind. But it's key to remember that these ETFs aren't set up to maximize on yields. They're designed for income along with some growth potential. And if we look at the returns, you'll see exactly what I mean. Since these ETFs were created on March 18th, ROCY had total returns, including dividends, of 10.6%, while ROCQ was nearly 18%. Over the same time period, JEPI had total returns of negative 0.59%, and JEPQ around 9.7%. So the strategy and setup of ROCY and ROCQ leans more towards a growth-oriented portfolio that's also benefiting from the current market. And if we just look at price appreciation alone, so no dividend income, you can really see the difference. Even ROCY seems to be showing some decent level of appreciation. Now remember, this is only around 3 months of history, so it's more of a data point than a historical track record. So take it for what it is. So are the old or the new JPMorgan ETFs better? Well, let's put it all together and take a look at the key differences. When it comes to the strategy, ROCY and ROCQ use call spreads and leave some room for more appreciation, while JEPI and JEPQ use ELNs and they also have some potential for appreciation. For the tax treatment, the new funds are mostly return of capital, while JEPI and JEPQ are mostly ordinary income. And for the expense ratios, they both match up here, which is nice to see. As for the dividend yields, it's still too early to say, but for now, I'll have to say that they're pretty close together. But more history will help clear this up later on. And for the performance, we still need some more history, but there's already a pretty big difference. I'm expecting ROCY and ROCQ to have much better appreciation than the other funds, while at the same time, I expect the dividend yields to be similar to each other, or maybe a little bit lower. And since these funds are new, we don't know how they'll handle big moves in the market, but the older funds have done pretty well so far. I'd also expect JEPI and JEPQ to handle volatility and dips better because of their more conservative approach. But the new and the old funds are pretty different from each other, so which one is best for you would just depend on your preferences. Now, before investing in ROCY or ROCQ, there are some key things to think about. First is the historical track record. ROCY and ROCQ have only been around since March of this year, meaning they only have 3 months of history so far. So they haven't experienced different market conditions like JEPI and JEPQ, so we have yet to see how they handle downturns. Second is that your monthly income is not fixed. There's only been 1 regular month of income history, so it's too early to say, but I'd expect some fluctuation in the income in the future. Now, it could be less than JEPI and JEPQ or about the same, but we need some more history to see how they turn out. third is that there's some solid income funds on the market to consider. These ETFs are still new, so I'd expect some hesitation for people to jump into them until we see how the income and the returns hold up. And I think these ETFs will perform close to the Goldman Sachs ETFs, GPIX and GPIQ that lean on appreciation, as opposed to more yield-focused funds like the NEOS, SPY-I, and QQQI funds. But we'll just have to wait and see. Also, these funds aren't giving you full exposure to the indexes that they pull stocks from. Both the new and the old JPMorgan funds aren't giving you exposure to most or all the stocks in the S&P 500 or the NASDAQ 100. So just something else to consider since they tend to pull stocks in from other indexes. The last one is capped upside. All these funds are going to limit the upside, so you're trading potential appreciation for that monthly income. And even if ROCY and ROCQ can provide better upside than the older funds, over the long term, they're going to underperform the underlying asset. But this comes with the territory of covered call ETFs. Now, if you want to see how ROCY and ROCQ stack up against other ETFs in the market, I go into the 9 best covered call ETFs for monthly income in this video here. If you made it to the end, I really appreciate you watching, and don't forget to hit that like button and subscribe for more content. Keep on investing, and I'll see you in the next one.